We are discussing chapter 9, which is getting financing or funding for a new startup or business. If you're looking for a startup funding, this is the right chapter which will give you a lot of information. Okay? And if you have any doubts related to it, it will be solved in this chapter. Let us understand what is funding. It refers to the money required to start and run a business. It is a financial investment in a company for product development, manufacturing, expansion, sales and marketing, office spaces, and inventory. So basically, execution of the business on a daily basis, putting money and how to run the show will require funding. So that is why it is required. Many startups choose to not raise funding from third parties because, of course, if you are taking fund from someone, you may have to return it, or if you face loss, you will be in liability or debts. And if you share the profit, your equity dilution will happen and your ownership will reduce. That is why some startups collect the money before they start a new business already so that they don't have to share their profits with anyone and they can carry on with their business with their own fund. However, this is not possible if you have to expand, and in the longer run, there will be more and more funds required for salaries and etc. That is why it's not easy. However, most startups do raise funding, especially as they grow larger and scale their operations. So, to magnify or to increase the business branches or to increase the number of employees, processes, products, services, you will need the funding. That is why it is important to understand from where to get all this money. If you are an entrepreneur seeking to understand why funding is needed, types of funding available, and how to raise funding, then read on to find answers to these important questions. Let's go to the next slide. Why funding is required? A startup might require funding for one, a few, or all of the following purposes. It is important that you, as an entrepreneur, are clear about why you are raising funds and where will the major chunk of it go and in which processes it will be required more. You should have a detailed financial and business plan before you approach the investors and a very concise PPT and understanding of why you need the money, where it will go, and what is your action plan for next 5 years. Prototype creation, product development, website and app development. All this will be required to show to your investors that you are serious about your business. Team hiring. Hiring itself is a strenuous work and requires you to take multiple interviews, shortlist the candidates, and give them demo products and services to be sold or to be applied their skill set to, so that you know that these team members will add value to everyone around. Of course, then you have to match the culture of the team members with the existing culture of your startup. Next point, legal and consulting services for your startup. Around 20 to 30,000 rupees it goes for trademark registration and to hire any consultancy that is required and to shortlist the logo and the brand name and tagline so that there is no challenge when you are already established and there should not be competitors imitating your trademarks or copyrights or intellectual property rights for that matter. That is why legal and consulting services are very useful. Next, of course, if you are selling tangible or physical products, which can be sold in the retail market or physical world, then raw materials and equipments have to be acquired and funds are required for the same. Especially if your equipments are imported or are expensive or require tax planning, then also funds will be required. Next point, licenses and certifications. Of course, there might be domestic license, current accounts, and other such GST registrations, and probably some certifications that may be required to show genuinity of your business. So funds are required for the same. And it is always wise to collect more funds than expected, because around 20 to 30% there will be more expenses or waste, because sometimes there is bureaucracy and sometimes probably you will have to donate some funds to make your things work faster. That is how the systems work in India. Next, we see working capital. Of course, on a daily basis, the amount of money required to run the business and your daily unexpected expenses, maybe for card swapping machine or to get reviews on Google, etc., will also require more input of funds. Marketing and sales is one of the major departments or processes which require funding, because people have to come to know about your startup. And social marketing is itself a very expensive affair, though it sounds that it is easy to promote on Instagram and LinkedIn and Twitter and Facebook, etc. But even a minor amount of sponsorship never works. A major amount of tie-up with a application or with a influencer always works, and they don't come cheap. The starting rate of an influencer who has more than 30-40,000 followers on Instagram may be nothing less than 50,000 rupees to 1 lakh rupees. That is why marketing and sales itself requires a lot of funding. And the more you put in this, the more output you may receive. The conversion ratio of every sector is different. Maybe 2 to 5% is the general conversion. So if you approach 100 customers, maybe 4 to 5 will be interested in your product, and maybe out of that 1 or 2 will purchase. So if you see, it's 1:100 ratio. So imagine the number of sales or subscriptions that you need to even reach a 1% of your market audience or a target group. Last point, office space and other admin expenses. Of course, in a city like Mumbai, the rent expense and the maintenance and the electricity and the furniture, all this requires enough funds. Or else, even if you take it from WeWork or something like that, per day cost is equivalent to your own office with less rent in suburbs of Mumbai. Admin expenses, even if you don't calculate, it may come, including your stationery, books, etc., and maybe maintenance of your computers. So miscellaneous expenses may be required. So this just gives you an idea what is the fund required for your business. There may be more requirement, but of course, this is to give an idea that minimum such things have to be kept in mind. Going to the next slide, scaling Series B and above stage. At this stage, the startup is experiencing fast rate of market growth. Of course, this we can assume that till now the sales have already begun and money has started flowing in and increasing revenues. Common funding sources utilized by startups in this stage are venture capital funds. VC funds with larger ticket size in their investment thesis provide funding for late stage startups. It is recommended to approach these funds only after the startup has generated significant market traction. A pool of VCs may come together and fund a startup because they may believe in the concept. So, as we were seeing how to increase the scale of your business and how to get funding for such things, venture capital funds we have seen. Now, next, we are just seeing a preview of private equity investment firms. Private equity investment firms generally do not fund startups. However, lately, some private equity and investment firms have been providing funds for fast growing late stage startups who have maintained a consistent growth record. So basically, they come together so that their money is invested together in startups and they share the liability accordingly. Okay. Next, this is a basic chart to understand the characteristics of investment. So first column shows equity financing, second column debt financing, and third column grants. So if we see the first row, nature, in equity, there is no component of repayment of the investment funds. So in equity, it is complete share of profit. There is no repayment. In debt financing, investment funds to be repaid within a stipulated time frame with interest. In grants, there is no component of repayment of the investment funds. It's like a donation. Next, we see risk. Risk factor for the investor is higher as he has no guarantee against his investment. In debt financing, risk factor for the investor is lower as he generally has collateral against his investment. And in grants, there is no risk factor for the startup as no collateral is involved. Pressure for repayment. Equity, less pressure for startups to adhere to a repayment timeline, but added pressure from investors to achieve growth rates or growth targets. In debt financing, more pressure for startups to adhere to repayment timeline, and as a result, more pressure to generate cash flows to meet interest repayments. And last, grants. No pressure for repayment as grants are a form of monetary support provided for a specific purpose. So this is self-explanatory, the points that we have seen till now. Let's see the next 3 points. Return to investor. Capital growth for investors in equity financing, in debt financing, interest payments, and in grants, no returns. Okay, so like I have told before, that capital growths in equity and the person who is getting income does not have to worry if the profit is there in the startup. Involvement in decisions. Equity fund investors usually prefer to involve themselves in decision making process as they have only put the money and they know that if the company faces loss, their money will also go down the drain. That is why they invest little bit of time also to understand and guide. And next, debt fund has very less involvement in decision making. So here basically they are more interested in the returns rather than getting into daily decision making. And in grants, no direct involvement in decision making because it's just one time affair where they give a lump sum amount of money for the entire year probably. Last point is sources. Angel investors, self-financing family and friends, venture capitalists, crowdfunding, incubators, and accelerators are probably the source of equity financing. While in debt financing, banks, non-banking financial institutions, government loan schemes like CGTMSE, Mudra loans, Stand Up India loans are included. And last, grants, central government, state governments, corporate challenges, grant programs of private entities may be included. So I hope this chart is very easy to understand and students have got it well. Let's continue with the next slide. Startup India state policies. There are various initiatives by the respective states that are taken to help accelerate the growth of startups in various states. They proactively work towards helping the startups and the entrepreneurs in their ventures by giving them relaxation in building angel network, state-funded grants, matching loans, success fee for fundraising. Various initiatives have been taken by states like Karnataka for setting up Idea 2 POC and Rajasthan for setting up iStart, etc. We will go through such 4 states, which will give us a lot of information what these states are doing for startups. It's really a golden period which is going to start for startups soon. Okay. Proactively work for startups means these are initiatives which are done for the welfare of people, especially who are venturing in a startup, maybe young crowd who do not know how to proceed. So let's understand what is the next slide about. And that is about the initiatives by 4 states, first starting with Karnataka. Government of Karnataka provides seed funding under the Idea 2 POC Scheme of Startup Policy of Karnataka 2015-20. Idea 2 POC is given in the form of granting aid but limited to a one-time grant of up to INR 50 lakhs. Aspiring entrepreneurs can apply for the scheme in incentive during call for proposal through an online portal. The website also mentions the required eligibility criteria. And there is a portal link of the same which you can easily find on Google. Next, Gujarat. State government provides seed funding to startups in the form of sustenance allowance, product development assistance, and marketing assistance. An amount of INR, that is Indian rupees 10 lakhs, is provided as seed funding. As you can see the maps of Karnataka and Gujarat down. So that is a great initiative by the Karnataka and the Gujarat government. Let's see what Jammu and Kashmir and Rajasthan state governments are doing for such startups. J&K government has launched Seed Capital Fund Scheme under which seed money up to maximum INR 10 lakhs and the project cost is provided to eligible prospective entrepreneurs to kickstart their ventures. Rajasthan. Government of Rajasthan provides seed funding in form of monthly sustenance allowance under the Assistance for Startup at Idea or Prototype stage of startup Rajasthan Startup Policy 2015. All eligible startups can apply for seed funding through iStart Startup Dashboard portal link. So great Rajasthan and Jammu and Kashmir state, we can see the maps down. Next, we see validation and incubators. What is it about? You must have heard these words if you are in a startup kind of sector. Validation is also called the seed stage. This is the stage where your startup has a prototype ready, that means a basic framework or blueprint or demonstration, and you need to validate the potential demand for your startup's product or service. This is called conducting a proof of concept, after which comes the big market launch. To do this, the startup will need to conduct field trials, test the product on a few potential customers, onboard mentors, and build a formal team. Common funding sources utilized by startups in this stage are: first, incubators. Incubators are organizations set up with the specific goal of assisting entrepreneurs with building and launching their startups. Not only do incubators offer a lot of value added services, office space utilities, admin and legal assistance, etc., they often also make grants, TEDS, equity investments. So I hope validation and incubators are clear. Let's see the next points. What is crowdfunding? So basically, crowdfunding itself means that people come together to fund a business. Government loan schemes also comes under crowdfunding. The government has initiated a few loan schemes to provide collateral-free debt to aspiring entrepreneurs and help them gain access to low-cost capital. Some such schemes include CGTS, TMSE, Mudra, and Stand Up India. Angel investors. Angel investors are individuals who invest their money into high potential startups in return for equity. Reach out to angel networks such as Indian Angel Network, Mumbai Angels, Lead Angels, Chennai Angels, etc., or relevant industrialists for this. Crowdfunding refers to raising money from a large number of people who each contribute a relatively small amount. This is typically done by online crowdfunding platforms like you must have seen, especially for medical assistance, people use this. Next point is early traction or Series A stage. This is the stage where your startup's product or services have been launched in the market. Key performance indicators such as customer base, revenue, app downloads, etc. become important at this stage. Funds are raised at this stage to further grow user base, product offerings, expand to new geographies, etc. Common funding sources utilized by startups in this stage are venture capital funds. Venture capital funds are professionally managed investment funds that invest exclusively in high growth startups. Each venture capital fund has its own investment thesis, preferred sectors, stage of startup, and funding amount, which should align with your startup. Venture capitalists take startup equity in return for their investments and actively engage in mentorship of their investee startups. We will see more about this in the next chapter too. Next, let's understand what is NBFC and venture debt funds. Banks or NBFCs. Formal debt can be raised from banks and NBFCs at this stage as the startup can show market traction and revenue to validate their ability to finance interest payment obligations. This is especially applicable for working capital. Some entrepreneurs might prefer debt over equity as their debt funding does not dilute equity stake. Venture debt funds are private investment funds that invest money in startups primarily in the form of debt. Debt funds typically invest along with an angel or venture capital round. Hope this is very clear to the students. It's a very self-explanatory terms, and we will be doing more about venture funds in the next chapter, so that will make the things more clear. TREDS. TREDS TREDS to decrease the financing concerns faced by medium, small, or micro enterprises in India. RBI, that is Reserve Bank of India, introduced the concept of TREDs in 2014, an institutional mechanism for financing trade receivables on a secure digital platform. Trade receivable exchanges such as M1 Exchange standardizes the process of funding MSMEs via invoice discounting. TREDS addresses the gaps in MSME industry as in enterprises face challenges in getting their payments on time, thus creating working capital discrepancies. TREDS is a timely and effective solution to drive the MSME sector to the next phase of Indian economy. So I hope this is one more way of getting funds for the entrepreneurs. And it is very clear to the students. Next, we will understand scaling Series B and above stage venture capital funds and private equity funds all together. So basically, after understanding this, we realize that there are a lot of fund options available across the market, and we just need to put them together. Next, we see this chart, which is about time and revenue for startups. So if you see, the left side is about revenue and the down part arrow is about time, the x-axis. So as the time passes, how the revenue model should work. Value of death is when the business closes down, which you can see below the x-axis. Then the first level is seed fund, seed stage. Then next level is angels, who are just rising with the money. Third level is smaller VCs, smaller venture capitalists or debt funds, early stage. Next, large VCs or last maybe mergers and acquisitions, strategic allowances, etc. This is a late stage where there should be high sales and growth in the business. And then the last stage is IPO, initial public offering, where because your income is so high that you can apply to the stock exchange. And then secondary offerings or something added advantage that can come due to brand name or free PR, it can be called. So if your brand is doing well, you will get automatic publicity in a lot of places. And then it goes to public market open for different geographies. I hope the chart is very clear, students. It's easy to understand and gives a picture of the entire life cycle of a startup, or at least the first half of the life cycle. Next slide is about due diligence by interested investors. Angel networks and VCs conduct a thorough due diligence of the startup before finalizing any equity deal. They look at the startup's past financial decisions and the team's credentials as well as background. This is done to ensure that the startup's claim regarding the growth and market numbers can be verified, as well as to ensure that the investor is able to identify any objectionable activities beforehand. If the due diligence is a success, the funding is finalized and completed on mutually agreeable terms. So of course, your past financial decisions and your intelligence or strategies or level of decision making and how that has helped to grow the company will give an idea to the investor whether to invest or not, and will make or break your business. We will continue the next topic in the next video. Thank you so much.